Good morning from beautiful Cape Town, and an even greater morning to the Bokke and our SA Airlink pilots. What an incredible sporting weekend and an incredible time to be a South African. Thank you for joining Spear's HY 2027 pre-close presentation. We appreciate you taking the time to be here with us this morning. It's just on 11 o'clock and we'll be getting into the presentation now. The first half of the financial year has again been a very active period for the Spear team. As a team, we set out key focus areas at the start of the financial year, and these were to ensure robust operational outcomes within the portfolio, to consistently maintain a strong financial cadence during the period, and to execute on our growth strategy for the period. Now, despite a slower start for Spear in Q1, Q2 has added the momentum we anticipated to the half year, despite ongoing volatility. As a management team, we are pleased that the objectives mentioned keep being met on a year-to-date basis. Globally and locally, the trading environment has been volatile as geopolitical tensions, conflicts, and inflationary pressures largely shaped the first 6 months of the financial year. Real SA economic growth remains evasive as interest rate creep manifests with a 25 basis point rate hike in May 2026. Now, despite these challenges, we remain sanguine about the year ahead and confident that we have prudently navigated the changing fiscal landscape over the past 6 months. Now, if there are any questions during the course of the presentation, please email them through to info@spearprop.co.za and we'll answer them straight after the presentation. Just having a look at what I'm going to be talking about in the course of the presentation today. This presentation will also be available on our website during the course of the day. You can just go to www.spearprop.co.za and under the Investor Center tab, you'll find the presentation. Now, getting into our update, but before we do that, just a reminder of our mission. Our mission is to be the leading Western Cape focused REIT, to grow our distribution on an annualized basis, and to operate within the top quartile of our peer group. Now, despite all the local and global volatility, Spear's regional and hands-on approach has ensured operational stability and resilience, with our year-to-date summarized as follows. Our distributable income per share growth is tracking at the upper end of our FY 2027 guidance. Spear's inclusion in the SA REIT and All Property Index on the 23rd of March has certainly been transformational for our business, unlocking major institutional demand and growth capital for our business. Liquidity ratios have equally been transformed, with over 1.8 billion rands worth of stock traded on a year to July basis. Management embarked on a successful accelerated book build, raising 1 billion rand of new equity from our shareholders in April 2026. This resulted in the successful acquisition of over 1.4 billion rands of new, accretive, strategy-aligned investment assets, which I'll talk about further in the presentation. We've printed positive revenue and NOI growth for the period respectively at 28.29% increase in revenue and a 29.41% positive NOI revenue. Cash collections have been strong at 99%. Our balance sheet remains robust and primed for growth, with a loan to value as at July of 7.48% and an interest cover ratio of 6.02 times. Portfolio occupancies remain extremely healthy at 96.37%. And now I tip of the hat to the portfolio management team, our leasing team and our asset management team. Positive reversions across renewals and relets for the period of 6.78%, well above inflation. And organically, we are growing the portfolio, unlocking embedded bulk, with over 140 million rand being deployed into new industrial developments in George and in Blackheath. All in all, a very positive summary of Spear's first half of FY 2027. Now, moving into a bit more granular detail from a highlights perspective, I've mentioned that we are tracking towards the upper end of our guidance. The guidance which was set to the market in May 2026 was a distributable income per share growth of 6% to 8% compared to the prior period, and we are set to maintain a 95% payout ratio. Operational performance has remained strong, with our weighted average lease escalation at 6.92%, occupancy rate, as mentioned, at over 96%. I would like to see that slightly higher. We do see that there is scope to get that occupancy rate a little bit higher, especially in the office portfolio. I'd like to see that closer to 97% by the half-year results presentation in October. Our weighted unexpired lease term is 28 months by revenue. As mentioned, the rent reversions as a whole at 6.78, but also notably on a renewals only basis, we printed a positive 5.50% reversion on renewals. Cash collections remain strong despite tougher economic environments. And then the growth of our Western Cape portfolio continues. Spear acquired, as announced on SENS, 2 high-quality assets, one in the commercial segment of the portfolio and one in the retail segment of the portfolio, adding in excess of 48,000 square meters of new GLA to the portfolio at an average yield of 8.99%. Both acquisitions are earnings enhancing from their respective transfer dates. Looking at the balance sheet, over and above what I have shared already, Spear has 800 million rand of liquidity availability, net of acquisition allocations, therefore putting us in a very strong position to be opportunistic and also to be have a first mover advantage on acquisition opportunities, given the fact that we have capital to deploy into Western Cape opportunities. Our solar portfolio has continued to perform extremely well. As at July 2026, our portfolio, 28 of our assets have got solar infrastructure, which is around 70% of the total portfolio. It has got solar infrastructure installed. We generated over 5.1 million kilowatt hours of solar power on a year to July basis, which is approximately 2.2 million kilowatt hours more than the prior corresponding period, which just talks to how we've really scaled the solar portfolio. From a penetration perspective, our solar penetration on a comparative period to comparative period has increased by over 6%, with a 20.20% penetration year to July 2026. Now, from a financial perspective, our solar portfolio is certainly making a significant contribution to the revenue pool of the business, with 17.46 million rand contributed in terms of revenue from the solar portfolio at very strong margins, with an NOI year to date of 14.79 million. Just having a look at the portfolio at a glance, it's a slightly backward-looking picture, and I'll get to the current picture slightly later on in the presentation. As at July 2026, 7.1 billion in assets across 40 high-quality Western Cape real estate assets. Our GLA under ownership, 625,610 square meters. We've also worked very hard to rein in some of the cost-to-income ratios. Obviously, operating cost pressures are real, and especially in Cape Town, we've had significant increases in rates and taxes, which we've had to absorb. So you'll see our total cost-to-income ratio has contracted a little bit to 44.49%. Our property cost-to-income ratio at 37.65%, and our admin cost-to-income ratio 6.94%. From a net asset value perspective, the tangible net asset value of the business is 6.43 billion rand. That translates into a 12.74 rand per share NAV. We successfully raised the billion rand in April, which we did a significant share issue, but also shareholders supported our dividend reinvestment program, which allowed us to retain another 108 million rands worth of cash to deploy into the portfolio through a very successful drip. That brought us to a final gross shares in issue of 517,589,651 shares. So having a look at our letting activity. In terms of our renewals and relets, you'll see across every subsector printing positive reversion prints. Commercial 4.26%, industrial 14.32%. We've got some very nice rental uplifts in that portfolio, and in retail 7.88%. On renewals only, you'll see on commercial, industrial, and retail all positive, with retail being slightly lower than what we'd like it to be. But we all understand and appreciate that retail is slightly under pressure, and we would far rather ensure that we renew leases as opposed to running the risk of vacancies, which end up costing us significantly more. But all in all, very positive, above inflationary print, and we don't see this coming back with any shocks in the interim period, reporting period, or in the full year. but it's also important for us to remain close to our assets and close to our tenants at this time, because certain tenants are taking a little bit more strain than others. And for us, as I mentioned earlier, at a 99% cash collection rate, it's really important for us to keep the cash flows strong and sustainable within the portfolio. Having a look at the balance sheet, extremely strong and well managed by our CFO. We are well within both our strictest covenants. Our strictest covenant from an LTV perspective is 50%, and need I say it's 7.48% as of July. We'll see in the sensitivity analysis now that does move out, but still remains well below our strategic band. Interest cover ratio of 2 times in the covenant, we're at 6.02 times, so extremely healthy. The breakdown of our debt compares to the FY 2026. You've seen a slight creep in the weighted average cost of debt as a result of that interest rate hike that came through in May, but we are consistently benefiting from improved cost of finance from our funders, which will kind of cascade through to the cost of finance as the year progresses. Then just having a look at the LTV sensitivity analysis, what the flight path looks like. You'll see as of July, 7.48% LTV. The acquisition of the Watergate Centre and the Santam Precinct will push that LTV up to around 23%, and then marginally there'll be a slight uptick over the next 12 to 24 months, which takes us to about 26.74%, which is still well below the 38 to 43% strategic band within which we prefer to operate, meaning that there's still sufficient headroom both on the balance sheet side and the liquidity availability side for us to scale the portfolio in line with our investment strategy. Then just having a look at the sectoral performance. Obviously, the segmented subsectoral operational performance does give us more of a granular reflection of the strength of the diversification of the portfolio and provides a look into how each subsector has performed on a year to July basis. If we look at retail, it's about 82,233 square meters of the portfolio, which does not yet include the Watergate Centre. Occupancy at 97.17%, collections at 98.07%, and our retail positive rent reversion 7.88%, renewals at 3.10%, in-force escalations at 6.69%, gross cost to income 37.54% compared to the prior period, which was 37.94%, net cost to income 14.08% compared to the prior period, about 14.93%. All in all, the retail portfolio is performing extremely well, and we are starting to see some real traction in some of the negotiations we have with our nationals, where they do take up additional space and are looking to increase their market share. In terms of our commercial portfolio, 121,378 square meters, which excludes the Santam Precinct for the avoidance of any doubt. Occupancies at 90.24%, collections at 100%, reversions positive at 4.26%, renewals only at 5.87%, in-force escalations at 6.18%, and the gross cost to income ratio also contracting, where 37.69% on a year to July. Corresponding period for the half year HY 2026 was 36.87%, net cost to income ratio 24.25% compared to the prior corresponding period of 21.81%. A slight creep there, and as I mentioned, operating cost creep pressures certainly are manifesting a lot more prevalent within the commercial portfolio, given the fact that you have a lot more costs running through your commercial assets as what you would have in the course of an industrial asset or a retail asset. Then in terms of our industrial portfolio, across the 422,000 square meters of gross lettable area, 97.98% occupancy, collections just under 100%, very strong rent reversion of 14.32%, just given the fact that there's such high demand for our multi-tenanted offices and large occupier spaces in the industrial portfolio, that we're able to really leverage that position to improve the reversionary percentages within the portfolio. On renewals, just under 6%, which we see as highly acceptable. Robust in-force escalation of 6.83%, and it's notable that this is over 60% of the portfolio's GLA that's pushing out these numbers, and it's really fantastic from a performance perspective. Gross cost to income ratio 37.94%, in the prior period 39.18%. The net cost to income ratio has contracted significantly at 2.90% compared to the prior corresponding period of 8.10%. And this is largely also as a result of the notable contribution that our solar portfolio in the industrial subsector is making to contracting that net cost to income ratio. Then just having a look at a general business update from a macro perspective, the portfolio has displayed incredible resilience during the half year, despite the volatility shocks that came through, which drove up inflation, which impacted interest rates and fuel costs. The Western Cape remains the strongest performing real estate market across the subsectors in South Africa. Now, some people have criticized me for saying that the Western Cape will continue to outperform the rest of South Africa. I stand by that position. If I compare the amount of money that the province and the city and the metro and all the other local authorities are putting into infrastructure, into investment, into attracting investment, coupled with the lowest unemployment rate in the country at about 18.1%, I do not see how any other region will outperform the Western Cape in the medium to long term. But we do hope that the rest of Africa can pick up steam. We've seen consistent renewal and leasing activity generated across the portfolio during the half year. Operating cost pressures are prevalent, but are being managed as best possible. As mentioned, we see that most prevalent within the office portfolio. We've done some accretive and strategy-aligned acquisitions secured during the half year, being the acquisition of Watergate and the Santam Precinct, which are accretive to the portfolio from their respective transfer dates. We've also ensured that we've unlocked shareholder value with the disposal of Hamilton House and Chiapini House in the Waterkant at a premium to the original purchase price and our book value. There's been consistent progress on our renewable energy strategy, contributing to the NOI growth of the overall portfolio. We've organically unlocked additional value through the growth of our industrial portfolio through development in George and in Blackheath. Notably, also a milestone for us in the half year was the conclusion of a new 10-year development lease for the development of the new Mambo's distribution centre in Blackheath. And equally today, probably for the first time, we share with the market that we've acquired the commercial land next to our head office building in Century City for an organic commercial development, which will probably cost around 950 million rand across 25,000 square meters of land with a bulk of one. And more of that detail will be spoken about in the interim results presentation, but I do speak about it also in the development, acquisition and disposals portion of this presentation. But really an exciting growth opportunity for Spear, in addition to having really bought well, which should unlock value for us in the long term. Then just having a look at our sectoral split. So you'll see that during the period, as I mentioned at the beginning of the presentation, a very active period for Spear with the acquisition of a 442 million rand retail asset, a 960 million rand commercial asset, and 107 million rand disposal of the Hamilton and Chiapini properties, giving us a net growth of around just under 1.3 billion rand and a net gain of around 43,701 square meters of GLA. If you look at the consolidated new acquisitions and disposals position from where the portfolio stands as at today, being the 31st of August, we've netted off the two assets we sold versus the two assets we bought, so we're still on 40 high-quality Western Cape assets, valued at just under 8.4 billion rand. From a value split, you'll see that commercial and industrial are effectively 50-50, both 38% of the portfolio, with retail at 23% of the portfolio. Retail GLA has increased to 101,914 square meters, and office GLA has increased to 145,398 square meters. And you'll see the point I made earlier, why it's important for us to have the industrial portfolio as that cornerstone. 63% of our gross lettable area within industrial is given that the operational metrics, being the in-force escalations, the rent reversions, and the occupancy rates, are at their strongest across within that subsector, and will continue to drive top-line revenue for the business, bring us to an occupancy rate of 96.6%. Then just moving on to the acquisitive growth, disposals and development growth for the period. As mentioned on SENS and announced on SENS, we acquired the Santam precinct in Tiger Valley. That property successfully transferred into the Spear portfolio on the 26th of August 2026. It's a 960 million rand acquisition across 28,488 square meters of prime commercial GLA in one of the key primary office nodes in Cape Town. It's got a passing gross rental of around 272 rand a square meter across the GLA of the property. We have a blue chip covenant and an incumbent that recognizes the strategic location of the assets and its long-term usage thereof. The acquisition yield to shareholders was 9.67%. The weighted unexpired lease term of 28 months with an in-force escalation of 6.50%. We are exploring some PV solar opportunities on this site at the moment, and we'll update shareholders in that regard at the interim presentation. Just also to speak to what's happening in the Tiger Valley area. According to the SAPOA office vacancy survey for the second quarter 2026, the northern suburbs office market comprises approximately 547,187 square meters of office space, of which approximately 73% comprises P grade and AAA grade office accommodation. Now, vacancy rates within those specific grades of office accommodation remain extremely low, with P grade vacancies at 0% and AAA grade vacancies contracting in Q1 from 1.5% to Q2 to 0.8%, underscoring the strength of the occupier demand and supporting positive long-term rental growth fundamentals for Spear. We certainly see this asset as a high-quality institutional fit for our business. Then, on the 27th of August, Watergate Centre in Mitchells Plain transferred into the Spear portfolio, which was 442 million acquisition cost across 19,681 square meters of GLA, which translates to about a 22,458 rand per square meter. We have an exceptionally strong tenant mix anchored by ShopRite, Capitec, Mr Price, Zone Fitness, Hungry Lion, and Steers. Around 77.3% of our tenants are nationals. Therefore, it does give us a strong credit risk mitigation. The average trading density on this property ranges between 3,400 rand a square meter per month, with the anchors reaching ShopRite and the other large anchors reaching around 6,000 rand a square meter, and our food trading density around 6,965 rand per square meter. The effort ratio remains in a low single digits at around 6.18% for the centre, which we deem to be extremely good. The initial yield on this acquisition was 8.37% to shareholders with a 24-month weighted unexpired lease term. The in-force escalation is at 6.7%. The asset also comes with a 1.2 megawatt PV solar installation, which will take our solar assets to 29 as at the 27th of August, which means that now 73% of the total portfolio is installed with PV solar. Watergate Centre is the dominant convenience retail centre in Mitchells Plain, and we see the centre as a growth asset over the long term, given the trading densities being printed and also a strategic location within Mitchells Plain. Then having a look at some disposals, we as a business always critically look at when assets have achieved what we deem to be its best and optimal use. We successfully disposed of Hamilton and Chiapini House for 107 million rand. The disposal yield was around 7.5%. The premium to the original acquisition price in 2024 was around 33%, and the unlock of NAV to shareholders with this disposal was around 5 cents per share. The proceeds of this disposal will be deployed into accretive acquisitions and developments as we go through the year. Then on the development growth side, our development in George is progressing very well. I'm also pleased to announce that we've concluded around 1,000 square meters of letting activity on the first, call it portion 165, which is around 5,500 square meters. Currently, you can see this is the picture of the current construction that's happening on the first parcel of the 30,000 square meters of GLA that we are unlocking over a period of time. This is tenant driven, but the portion 165 being multi-tenanted, ranging from 500 square meters to say 5,500 square meters, typically that you have to build slightly before the letting takes place, because tenants that move within that space bracket don't generally make decisions 2 or 3 years in advance. They make decisions to move between 3 and 9 months prior to their leases coming up. So we want to be active in that market and just basically vindicating our decision to go on this first development has resulted in the first lease being signed at our feasibility rentals, and it's on track to deliver Q4 FY 2027. Then, as announced to the market, we've concluded a 10-year lease with Mumbo's Home and Storage, and that construction has commenced, and we will deliver the final modern warehouse to Mumbo's in August 2027, 7,150 square meters, and this is again unlocking embedded bulk within the portfolio in Blackheath in our Bravo Park at an initial yield to shareholders of 8.6% and a capital cost of around 89 million rand. Then just taking a forward-looking approach. For those shareholders that have been shareholders within Spear for a long time, you've seen our Pardon Island development feature on an ongoing basis, and I assure you that works are in progress and further announcements regarding this development will be forthcoming in the not too distant future. Then having a look at the parcel of land that we acquired from the City of Cape Town at their most recent auction in February 2026. It's the building to your left is our Waterhouse building in Century City, and the land to your right, that's 2.5 hectares that we have the rights to develop. The rights are already in place, and we can develop 25,000 square meters of high quality office GLA. The bulk rate is important because it's not a typo. It certainly is the bulk rate that we paid, and we think we can bring a very high quality premium product to the market at very competitive rentals in the not too distant future. Then just having a look at the outlook, we remain resolved in our strategy to achieve a mission statement aligned outcome in FY 2027, as Spear's key performance indicators continue to deliver in line with our operational and financial strategy. Our outlook for the financial year remains positive, and the half year is summarized as follows. Our DIPS cadence is tracking at the upper end of our guidance. Our reversions were positive. Our cash collections strong at 99%. Our solar PV portfolio is contributing material NOI to the portfolio of 14.5 million. We've seen an improvement in our overall cost to income ratios as growth assets are stabilized and we start to benefit from the economies of scale, which again is another manner we try and absorb that operating cost creep. Our successful capital raise has given us the courage of our conviction that our business is going in the right direction. We have investor and shareholder support in terms of our strategy. Our loan to value remains extremely robust and really primed for growth. Our acquisition-led growth strategy is paying off with the implementation of our recent acquisition of Watergate and Sanlam. And also, just for the avoidance of doubt, just talking about these two new acquisitions. The DIPS guidance that we talk about today has not yet considered the accretive contribution that Watergate Centre and Santam Precinct will have on FY 2027 earnings. Management will provide an update on this DIPS guidance for the year at our half-year results presentation in October. Now, the above displays strong key performance indicators for HY 2027. We're confident we can continue to build on this momentum created in the half-year, and we will endeavour to consistently update the market as new things emerge within our business. So for the half-year, we will reaffirm our guidance at 6 to 8% growth, subject to the guidance assumptions set out below. We'll maintain a 95% payout ratio as approved by our board of directors. As always, our guidance assumptions have to be read in conjunction with our guidance that there'll be no load shedding for the remainder of FY 2027. Vacancies are reduced in accordance with management's forecast. Lease renewals are successfully concluded as per management's projections. No major tenant failures occur over the balance of FY 2027, and we also don't anticipate any. Tenants continue to successfully absorb rising costs associated with utility charges, municipal rates, and other local authority charges. Any further shifts in monetary policy are absorbed during the year, and no civil unrest in Cape Town, the Western Cape, or South Africa. Any deviation from these assumptions may have an impact on our forecast, which for the year ending February 2027. This now brings us to the end of the pre-close presentation. I want to thank you all for joining us and being in attendance via our YouTube channel today. I'll be back shortly, joined by our CFO, Christian Barnard, to take any questions that may have come through, and we'll host the Q&A. Thank you very much. Welcome back to the HY 2027 pre-close Q&A session. I want to just also extend a warm welcome back to our CFO, Christian Barnard, and also congratulate Christian and his beautiful wife, Joni, on the arrival of their beautiful boy, their son, Christian Jr. And yeah, first day back on the job. So welcome back straight into the spotlight. We've only received one question, and that is from Trinity at Anchor Capital. Could you shed some light on why guidance was not upgraded, given earlier transfer of the Tiger Valley offices and a few interest rate hikes than forecasted? So I think, Trinity, what we've always prided ourselves in is that we want to make sure that we have all the information at our disposal. The transfers have occurred slightly earlier than anticipated, but these assets are still being stabilized into the portfolio. When we have absolute certainty as to what the financial effects will be, we know that they will be accretive and they will contribute. And also, once the CFO's seat is slightly warmer than what it was for the past 2 or so months, we certainly will update the market, and we'll also give a far more detailed guidance presentation at the interim results presentation in October. We do have another SARB meeting coming up now in September. Yes, the inflation print was slightly lower than what market expectations were, but we also are experiencing, as I mentioned in the presentation, a period of incredible volatility. We're seeing fuel price continue to increase. It may force the SARB's hand, and all of these factors flow into why we decided to not update the guidance yet, and we'll update the market once we've also run the process from a governance perspective through our board at the interim results presentation in October.
Yeah, maybe if I can just add, the guidance will also be very much driven to the fullness of HY27, meaning we still have to conclude August, which is still a winter month. Yes, we are at the end of it, but we still have to conclude those numbers. Together we also have to consider what any possible indication would be in terms of a possible drip happening in November, which our board wants us to consider once again. So all of these things will be discussed and reviewed in the next month or two now that I'm back, and we will then provide full guidance when we know for certain what the numbers would look like towards the end of the financial year. And currently there's no other questions that come in, but please do send them and we will answer them via email, or you're happy to call or WhatsApp as you always do.
Excellent. Well, thank you very much. That seems to bring us to the end of the Q&A session. And we thank you for tuning in today, and thank you for your ongoing support, and look forward to reporting back on our HY 2027 results in October. Thank you very much.